Now we're ready to begin. Thanks very much for your patience. First of all, I want to wish you all a good afternoon and welcome you to today's webinar. Today's webinar is going to be on the U.S. natural gas markets in a post-COVID world, presented by NUS Consulting Group. I'm Richard Sultanian. I'm co-president of NUS Consulting Group, and I'll be today's moderator. Today, I have with me Andy Potts. Andy is the senior consultant at NUS Consulting Group, specializing in the energy trading and risk management area. Andy has over 23 years of energy commodity market experience and really is a specialist in the U.S. natural gas markets. First of all, thank you, Andy, for making the time for today's webinar. Just a few housekeeping items before we start. Today's webinar will last approximately 30 to 45 minutes. We've consciously kept it short because we know many of you have been on many webinars in the last few weeks and conference calls and are probably experiencing a little bit of Zoom call fatigue. I believe you can submit Q&A on through the Zoom's platform, and if you do that throughout the webinar, at the end of the discussion, we will do our best to answer as many of the questions submitted as possible. And finally, all of the views presented today by Andy and myself on behalf of NUS Consulting Group are clearly for informational purposes, not for trading purposes. And with that, I think we'll begin with our first question. So Andy, one of the things I think that is very helpful in helping people understand the natural gas markets was that prior to the COVID crisis, U.S. natural gas prices were trading sub $2 per decatherm. Maybe as a way of providing some people some background pre-COVID crisis, why was the market trading at such sort of subdued levels prior to the advent of COVID? Andy, are you there? Did I lose you, Andy?
Can you hear me now?
Oh yeah, now we can. Go ahead.
Okay, sorry about that. Yeah, so number one, obviously this is a great topic to start on here, is where was the natural gas market kind of pre-COVID? You know, the story behind where we were here, it summed up very easily and succinctly is that the natural gas market was very bearish, in my opinion. The market was well supplied, and it was coming out of a very warm winter. I think that the chart on the left there kind of sums it up really well, is that, you know, prior to going into the heating season, we saw NYMEX futures reach as high as 290.5. But as the heating season had progressed, the effective result was by the end of March, we had seen futures drop down to a low of about $1.50, which in terms of historical standpoints is very significant, because this matches a low point that we hadn't seen for NYMEX natural gas futures since 1998. So if everyone kind of remembers the winter of last year, it was really the winter that wasn't. It started off a little cool in November, which helped kind of spike the market up a little bit. But when you look at the winter in whole, by the time we got through the end of the heating season, which ends in March, it actually went down as the 4th warmest winter on record. Effectively, what that meant is natural gas in storage was very ample. We just didn't pull enough gas from storage because effectively we didn't need it to meet the heating demand. We ended the natural gas withdrawal season with about 2 trillion cubic feet of gas in storage. When you look on the production side, which is kind of that chart there to the right, natural gas production in the United States for the first quarter of 2020 was hovering at 92.2 billion cubic feet, which was right near kind of our record high level. So again, the key contributors were high levels of natural gas production. Storage levels were extremely high based on a very warm winter. And, you know, quite frankly, the economy was just doing okay. It was chugging along, but it wasn't exactly extremely robust. So industrial demand and everything was a little bit down. So we had a lot of factors in play that effectively were pressuring prices lower, making my opinion of the market very bearish at the time.
Yeah, so maybe to summarize, a warm winter, lots of supply, fairly tepid economic growth set us up for a very weak market going forward, which most people who weren't hedged or had a great deal of exposure got the benefit of. Then this completely unforeseen event, COVID, upends the entire situation. As a result of COVID, the market changes completely. So maybe, stepping from pre-COVID into, the start of COVID and the lockdown, you can talk about how the COVID situation changes the market.
Absolutely. I'll refer to the COVID event as what I call like a black swan event. It's something nobody really planned for, nobody had really seen before, and quite frankly, in the 23 years that I've been in the natural gas business, I can only recall a handful of times where we've had similar, not even close to like this, but similar events, so we could deem these to be black swans. Effectively what happened here is the COVID situation did two things. It hit both supply and it hit demand. The chart is most end users who are looking to say, okay, well, how did this impact me and how does it impact price? Well, one of the things I want to highlight here is that, the chart on the left, which is a chart of the NYMEX natural gas futures curve for the entire 2021 time period. You can see that by the time the end of February, beginning of March, when the understanding of COVID was effectively going on and the market was realizing what was happening, the natural gas forward curve for 2021 shot up pretty immensely. We went from a low of right around $2.20 all the way up to a high of about $2.80. Effectively, that's almost a 20% market movement in a very, very short period of time. And you can see we've been treading a little bit of water since then in kind of a consolidation phase. But the first kind of reaction was definitely on the pricing side. When we step back a little bit and we start to figure out, okay, well, what is driving these events? Some of the things that, for me, that the COVID brought to light was that it certainly highlights how complex the natural gas market has gotten. For many years, the natural gas market, it was a domestic market. We didn't really have to worry too much, except for, was there going to be a winter? Was there not going to be a winter? Was there going to be a hurricane occasionally? Well, a lot of those simplistic ways of viewing the market, I think, are long gone right now. One of the things that we look at right now is daily production. Now, from the chart below, but previously, pre-COVID, I had indicated that, the natural gas supplies were very robust. But as you can see on the second chart here, you start to see a major drop off in natural gas supply. We went from averaging, 92, 93 billion cubic feet per day, effectively right there at the beginning of the April time period, all the way down to a low of about 83 billion cubic feet in May. And we're hanging out right now kind of sub 85 right now here. So we've had a noticeable drop in the amount of gas that is available to us right now. And the biggest driver of that drop in gas comes from what we call associated gas. A lot of people say, well, what's associated gas? What does that mean? Well, effectively, when gas is coming out of the ground as it relates to the production of crude oil, gas comes with it. You get a lot of other things out of the ground when you're drilling for crude. You get, butane, you get ethane, and guess what? You get natural gas as well. It's a byproduct. People aren't necessarily looking for it, but it comes for it. So when the gas comes out of the ground as a result of drilling for crude oil, that gas gets put to market. And when you look back historically at the growth of natural gas in the United States, about a third of our domestic supply comes from associated gas. And that is something that was highlighted immediately kind of during the COVID event, because I don't think most people really realized, how much the dependence was on our gas supply that actually was intertwined with what we were getting from the crude oil production.
Yeah, so maybe to summarize, COVID has an interesting impact. It impacts demand because of all these stay-at-home orders and all of these, businesses and industries that went offline. So we saw a significant drop in demand, but ultimately we also saw, as you were pointing out, a significant drop in production, which were sort of, competing against each other. So at first it looks like prices pulled back, because people saw, demand and thought supply would be steady, and then they realized the impact of demand. Is that sort of summarize it right?
Yeah, that's exactly right. And a lot of people were forecasting were, he were looking at, the numbers for crude tumbling and realizing that the associated gas level was going to come down with it, is they start to look at some of the demand metrics and say, okay, yeah, short term right now, yes, everything's kind of on hold. It's like you hit the pause button. But as they start to project, when things kind of return to some degree of normal, that the demand values will be going back up. But does that mean that the associated gas that we're getting from crude, will that go back up too? Are crude prices going to increase that are allow some of these wells to be brought back online? That's going to bring that gas back into the equation. Now we were already factoring 2021 was going to be looking like a tight market. What COVID did here is it just brought this to the forefront very quickly and just really accelerated that tightness, in our opinion, which is why we saw this very sharp run up in future prices for natural gas, which was kind of contrary to what you were seeing in other commodities.
Right. No, that makes a lot of sense. So one of the areas that many people have pointed to as a sort of a shining star in the U.S. natural gas market has been the development and exporting of LNG. That has certainly been an area where, we've seen a lot of offtake of gas, certainly pushing the U.S., which was much more, as you said earlier on, a domestic market, but making it much more of an international player. I guess one of the follow-on questions of this is, and this has both a supply and a demand sort of aspect to it. How is COVID going to impact the LNG market in the U.S.?
That's a great question, Rich. And, LNG certainly, over the last couple of years has been, a shining star, as you had indicated, of what domestic U.S. shale can do for the country. We started exporting our first amounts of natural gas back in 2016. As it stands right now, we have a fully functional 6 LNG export facilities that have the ability to produce about 10 billion cubic feet per day of natural gas for export capabilities. Now, it's kind of important to remember here that this is what I call phase 1 of the U.S. LNG transformation. These were plants that were built and they signed long-term commitments with off-takers, mostly companies in Europe and Asia that were set to take this cheap American gas, liquefy it, transport it across, and then use it in either Europe or Asia. So effectively what had happened here is that when COVID ultimately hit, the drop in LNG demand globally became a problem. You can see that on the right chart there that kind of talks about the amount of daily gas that was being used to kind of fuel the LNG process. We were averaging right about 9.5 billion cubic feet per day. Where we are today right now, we are well beneath that. We're averaging just 3.8 billion cubic feet right now so far in June. So that's a monster drop off. And the result of what's going on right now is it's twofold. Number one is that prices in Europe and Asia for natural gas and LNG have just crumbled. COVID, don't get me wrong, was a huge contributor of that as demand was kind of weakened across the board. But Europe had a very, very warm winter as well, and their inventory levels right now they're extremely full, just like the U.S.'s effectively are. So effectively, what happened is European and Asian prices for LNG got very, very weak, and then the cost benefit of off-taking LNG and shipping it across to Asia and Europe became uneconomical for a lot of the off-takers who had signed up to these long-term contracts. And they realized that, hey, we can get out of these contracts because they're take-or-pay agreements. We can pay our penalties, if you will, and still find LNG cheaper and make it a more economic decision to buy local, if you will, as opposed to exporting LNG. So we started to see a flood of cancellation notices reaching all the LNG terminals from the off-takers that said, you know what, I know we're contracted to take it, but guess what? We do not want to take it. So effectively that has dropped down the need for domestic natural gas in the short term.
Yeah. So if my math is right, if we were exporting about 9.5 BCF and now we're down in the low threes, this is another one of those contributing factors we just talked about. Although supply overall because of associated gas and other things have come down. On a contravailing view, the loss of all of this LNG leaving our shores has sort of helped cushion some of that supply blow, I would guess.
Absolutely, and it's done more than cushion it a little bit here. It's kind of put more gas into the near-term market that has to find a home, and that home, more often than not, is going into storage. So it kind of took a very bearish slant on the near-term markets we had discussed prior to COVID, and quite frankly, has made it even more bearish in the near term.
And I guess based on the information that you have, is the cancellation of these LNG cargoes something that you expect to see for the remainder of the year? I mean, how much visibility do we have on that?
So this is where the status of U.S. gas getting more complicated is, because we have to take into consideration, well, what are prices going to be doing overseas to see, is it economically going to still be viable? And what the market is telling us right now is that we can probably expect the highest amount of cancellations to be seen in July. We're already starting to see notifications to LNG operators for cancellations in August, but they're expected to be fewer cancellations in August. And I fully expect by the time we get through September and October, we will probably return. If you start to focus on the value of natural gas in the United States compared to European and Asian markets, once we transition to the fall time period, the spread or the cost difference starts to widen pretty significantly and kind of brings the U.S. market back into money. So in my opinion, I do believe that we'll start to see the cancellations start to ebb a little bit by the end of the fall time period, and probably return a little bit more closer to normal under current situations and current market dynamics over that we're seeing in Asia and in Europe. So yes, I believe that LNG is going to be coming back alive here, and this lull that we're seeing right now is just really limited to the short term, at least for now.
That clearly would be supportive of price.
Absolutely.
One of the things, sorry about that, but one of the things that you mentioned earlier on was, this concept of associated gas and the linkage to crude. And, there is no doubt that, the U.S. crude oil story has been, an extraordinary one with, production, earlier in the year hitting 13.1 million barrels per day, which was, far outstripping any other producer in the world. But one of the questions, that is raised from that linkage is, how tight is that linkage? Different shales plays have different characteristics. So in your view, how tight is the linkage between U.S. crude oil prices and production, and natural gas?
You know what? I think that the link in the price between natural gas and crude oil has gotten extremely strong. Many, many moons ago, the old joke used to be that, because on the trading pits of the New York Mercantile Exchange, crude oil and natural gas were next to each other. And that was really the only link that you had going on. If there was excitement in one pit, maybe there was excitement in another pit, okay? But there was really no fundamental connection kind of between the two. But with the kind of development of shale exploration, that has changed the dynamics. And I highlighted here on this chart here, the Permian Basin, which effectively is West Texas and New Mexico, is one of the largest growth areas for both crude and natural gas production. The chart that I kind of put together for today's discussion, dates back from 2016 till present. You can see that, the huge uptrend that we have for both production of natural gas and the production of crude oil. To indicate your point earlier, you had indicated that, hey, the United States was producing almost 13 million barrels of crude per day pre-COVID. About 5 million barrels of crude were attributed to the Permian Basin, whereas a couple of years ago, that number was, in 2016, it was below 2 million. So there was a huge increase in crude production coming out of the Permian, and because of this associated gas, there's been a huge increase in natural gas production. The Permian was peaking at almost 17 billion cubic feet per day of our daily natural gas supply. It put it as the second largest production region in the country. So you link crude and natural gas together, and you can see just from this one specific play, they have become intertwined. And just to kind of follow suit here, you can see that the longer term chart at the bottom there, which kind of takes the average monthly crude price and kind of expanded over time kind of shows that as crude prices continue to move up higher and higher into the $50 and $60 range, we started to see more and more production come online. Then all of a sudden, wham, prices start to tank on the crude side. And not surprisingly, oil production and gas production began to dip pretty dramatically as oil operators began to shut in their wells due to unprofitability.
Now that makes a lot of sense. And it's interesting, at least on the oil side, which is the area that I focus on for the company. Oil, as you said, really took a knock during the start of the COVID crisis and has rallied back pretty strongly, largely because, OPEC Plus has increased their production cuts. U.S. shale production has dropped, as you've highlighted, and that's pushed WTI back to around the $40 level, Brent a little bit higher. I guess the question is this high enough to start turning some of this around in the Permian, or do you think it's still pretty much in the middle and, companies are sort of, not going to be non-committal in the next few months?
Well, it's kind of funny that you bring this up here because it seems like almost as fastly as some producers began to take wells offline as the crude oil markets have corrected themselves, we've seen more and more notices from these same production companies that they're going to start gradually bringing supply back online. So I expect that if the existing market for crude continues to trade in its current trade bound range of, call it high 30s to kind of low to mid 40s, then I would fully expect that we would start to see some of these wells that were closed start to reopen again here and production potentially increasing along those lines.
Yeah, that makes a lot of sense. A lot of our discussion today has focused around shale plays in the U.S., both on a crude oil side and then on a natural gas side. There's no doubt that, in the headlines, we've seen a lot of headlines about companies that have sort of, as a result of COVID or as a result of the weakness in prices, have been having financial difficulties. I guess one of the questions I had for you today is, do you foresee a lot more bankruptcies coming out of the sector?
You know what, Rich, another great question here, because I think this has got long-term implications, is that the short answer is yes. We have already seen several E&P companies of the smaller nature already start to declare and being forced into bankruptcy. There are 5 or 6 that are kind of listed on the slide right now. But, I think to take a bigger view here is that 2 things stick out in my mind. Number one, there was a recent study by Deloitte that indicated that, 1 in 3 U.S. shale companies are technically insolvent with crude at $35 a barrel, and that's pretty scary. Number 2 is the chart on the right here, which kind of sums up that since 2010, the shale oil and gas producers have burned through $342 billion. I mean, creating positive cash flow has been hard. And I tell you what, the shale industry it's really getting some negative feedback from the street, in my opinion. It's estimated right now that there are over $300 billion in asset write-downs for 2020. When you look at that number, it sounds big. But also when you compare it to the market capitalization of 2 of the biggest oil companies in the world, Chevron and Royal Dutch Shell, which combined have a market capitalization of $305 billion, it's a monster number. So in my opinion, I believe that there are going to be more bankruptcies coming. Some of the things that we are looking at, right now is that, bankruptcies are coming. We believe that's going to happen. One of the things that we don't have listed here, or something that we haven't talked about yet here, is the natural gas and oil rig count. Back in the January of earlier this year, the rig count had been averaging around 1,100 rigs. Right now, the drop off has been unbelievable. Right now, we're down to about 260 rigs. So we've had a major drop off in the rigs. And this has become problematic, in my opinion, because the interesting thing about shale, especially for gas standpoint, is that shale wells decline extremely quickly. The rate of output is as high as it's going to get as soon as the well is cracked open. Okay, and you have a very steep decline rate, which means that you have to continue to bring more and more wells back online just to keep up with your existing levels of production. So the fact that the shale industry is in such financial dire straits, I think is a major factor that we need to be very aware of for both the short term and the longer term, prospects of the energy business here in the United States.
And this would sort of support what you were saying, that you foresee down the road the market tightening, because if the amount of funds flowing into a lot of these different shale players starts to tighten up, and banks start to be much more, let's say, prudent about lending, that means they're not going to be able to have enough money to drill and replace a lot of these wells that are deteriorating and starting to fall away. So that'll be certainly something to watch out into the future, and how that impacts the supply, at the end of this year and early next.
Absolutely, it's something that I think, and again, it just highlights, how complex the industry, the natural gas industry in particular, has gotten when you're having to worry about the financial health of a lot of the major producers of natural gas and what their future holds. And a perfect example is Chesapeake Energy, which used to be the darling of the shale boom when it first began here. And these guys are teetering on the edge of bankruptcy, and we're kind of expecting potentially any day now that we're going to see them, start filing. So, I mean, it is just shockingly bad how the financial state of a lot of these producers are.
Yeah, Chesapeake is definitely one of those stories. Clearly a darling of the market, an innovator, and then all of a sudden now in this sort of situation, teetering on the edge of bankruptcy certainly is an eye opener. One of the phenomenons, and certainly seems to have caught most people's mindset at this juncture during COVID, was negative pricing. Through a portion of last year in different regions in the U.S., we saw natural gas prices go negative. Can you give us a little bit of color on that and why that happened, and whether or not you'd expect to see that, throughout the rest of this year?
Sure, and I think that the regional natural gas prices going negative was certainly, it's one of the things that, after being in the business for so long, something that I hadn't quite expected to see, but here we are currently facing that scenario, or had been facing that scenario in some areas of the country. And what we're looking at right now here is a chart of the spot natural gas market in the Permian Basin. Again, the Permian Basin, as you remember from the previous slides, was effectively where a lot of the crude oil and associated gas production had begun. If you look at this chart and you see for the first, call it, quarter of the year, it was not unsurprising to see negative values or close to zero values for the daily value of spot natural gas. This is largely due because so much gas was coming out of the regions that the region was constrained. There was not enough physical infrastructure to effectively move the gas to market. There was too much gas going on, and the operators of these wells had two options. They could either sell their gas at a loss, or almost a near loss, or they could flare it. And of course, flaring obviously gets a very bad rap. You get into issues with air permitting issues and whatnot in various states. So a lot of people were effectively paying marketers to take gas off their hands and take it from them. Remember, gas was a byproduct. Okay, people weren't going into these regions and drilling for the gas because they wanted the gas. No, they want the crude. They want the very rich liquids that come with it. Gas was an afterthought. And if people have to pay to get rid of gas, so be it. It was still economical to drill and get all the crude and crude-based products out of the ground and lose money on gas. Wasn't a big deal. This was certainly highlighted by the fact that at mid-April, prices had dropped to a minus $5 per decatherm range here, which is pretty absurd when you think about it, only to rebound very sharply. And you can see it's not a coincidence that as production started to pull back out of the region, prices in the region began to move higher. Now, they're still cheap from a regional perspective. When you take a look at the United States in general, pricing a little bit over $1 a decatherm is not exactly super expensive. But when you consider that not too long ago that we were at break even or even below $1, that represents a pretty significant price movement. But it's just one of those characteristics of the natural gas market, which is becoming clearer and clearer, is that the U.S. is getting very regionalized from a market standpoint, and negative prices certainly are something that we have to consider based on near-term supply-demand functions.
No, thanks, Andy. That really does help clarify it a bit. I'm going to ask you to put your forecast hat on a little bit, and maybe give us, I'm going to put a slide up that you prepared for us, and maybe give us a little bit of view of what you see as the supply and demand balance for the remainder of 2020 and into 2021, and how you see the price action in that, the balance of this year and coming into next year.
Absolutely, be happy to. So effectively what I've tried to do with this slide here was I've tried to identify how much supply we have. And by supply, I'm really talking about two components: how much we are domestically producing, which is something that we have talked about, a lot here on this little webcast, but also talking about how much gas we get from Canada. The United States has always been a net importer of gas from Canada, and that's going to continue to be the case. So when you kind of mush the two together, you get kind of this total supply picture. Effectively, what I've done here is I've kind of recreated the first 5 months of the year, taking into account how much gas we have coming in, and then looking at all the major demand drivers of use for natural gas. There's power generation, there's industrial load, there's rescom, which is residential and commercial. There is plant fuel like for gas gathering and processing plants, as well as associated losses on pipelines that go with gas. And then you have the two major kind of exports. Again, the US market is going global now because we are effectively pushing gas via pipeline over into Mexico now. And also we are exporting gas via LNG. So I've taken a look at the 5 components, and you can kind of see that over time, it's basically how I'd expect it for the first 3 months of the year. We have a demand imbalance during the winter months because heating demand is still a requirement. It is winter time. So use, for example, in the rescom sector was still high. Granted, it was a warm winter, but you know what? It wasn't 70 degrees and sunny everywhere either. So we still had, some weather to contend with, and we still had a need for heating. So yes, we were drawing gas out of storage. So we were using the storage gas to supplement that imbalance. Then as we transition over into April, which is kind of the shoulder season, we start to inject more gas into storage. But this is also right when COVID was starting to take effect. You can see that, from our standpoint, we started to see hits affecting the industrial sector. We started to see hits affecting the LNG sector. And those are the two big ones that I think, in my opinion, are going to be, two big drivers over the remainder period of time. Yes, we're going to have some power generation needs this summer. It is going to be hot out right now. June is actually going to finish the month probably going down as about the 4th warmest June on record since 1950. And our projections indicate that about 35.2 billion cubic feet of gas per day will be going to the power gen sector in June. And then we have amplified those volumes as we get through July and August. But when you start looking at that industrial sector, that is just flat. There's really no growth going on there right now. In fact, we are actually losing ground a little bit in July. And then you factor in what's going on in LNG. We already know about all the cancellations that have happened in June. We know about the cancellations that are going to happen in July. We're starting to hear about all the cancellations that are going to happen in August and maybe September, and then maybe see those rebound. But effectively what that does is you look at this balance that we're going to have every day for the next few months. And we were putting a lot of gas into storage during this summertime, when normally these volumes would be smaller, and especially during the shoulder times for this upcoming fall time period, which means that, by the time we get ready to go into the winter heating season, I fully expect storage inventory levels to be almost at maximum working capacity. So I think that, like I said, it's a tale of two halves of the year, Rich. A very, we'll call it, an okay start to the year, followed by this middle ground here where there is just effectively too much gas going on right now, and it's all going into storage and finding a home there. It's not really going to market.
Yeah, and then you see that tightening up in the back end of the year as the weather starts picking up and LNG starts picking up, as well as when those spreads with Europe and Asia start to make it economic to move again. And that seems to be, when I look at your numbers, seems to be a similar story for 21. You seem to believe that, supply is going to stay a little, muted. It's not going to grow much. And, demand's going to continue to grow as power gen continues, replacing coal, and industrial usage starts to come back online.
Yeah, and I'm kind of viewing this as a standpoint of an economic, I'll call it a swoosh recovery if you like the Nike symbol. It's not going to be V-shaped. It's maybe not going to be really a U-shaped. It's more of a swoosh shaped, if you will. But you hit the key topic's pretty good. Power generation is going to continue to be, an influence for natural gas. Over the last couple of years, we've retired a lot of coal-fired generation, and coal-fired generation has been replaced with natural gas and renewables. In 2020, we're scheduled to take 8,000 megawatts of coal offline. 2021, that drops down a little bit right now for planned retirements to 2,000. In 2022 and 23, it's another 6,000 megawatts each for those years. But also, we're taking out some nuclear capacity as well. We're losing about 2,500 megawatts of nuke capacity in 2020, another 4,000 in 2021, and another 1,000 in 22. And gas is going to continue to play a major role in filling those voids. So, yes, my expectations are that power generation will continue to grow. My expectations are that the industrial sector, albeit, it's going to, in my opinion, return a little bit more to kind of like what we saw in 2019 levels here. It's not going to be exactly going, gangbusters, but I think it's going to kind of get out of its existing lull that we're in right now. And then we start to factor in other factors like LNG exports continuing to increase and whatnot. You can see that over the course of time, especially during the 2021 time period, the supply demand balance, starts to get out of whack a little bit. And on average, I'm projecting that for the year, that we're going to be at about a 3.4 billion cubic feet deficit, which means we're going to have more demand than supply available.
And that leads me into the slide I sort of previewed there, but showing your, storage forecast, 1920 versus 2021, and how we're going to start pretty high in inventories, and then you're going to see a crossover. Maybe I'll let you walk us through that one.
Yeah, so effectively what I try to do here, it's a tale of 2 years, effectively, 2020 and 2021. How is storage effectively going to look? Again, we've been discussing on, here, for the last several minutes here about, how bearish this natural gas market is. And with a lot of supply still available, albeit kind of curved back a little bit, gas doesn't really have a home to go to except for storage. So I fully expect that, that we're going to be entering the storage season at an all-time record high. I'm projecting right now just under 4.3 billion cubic feet, or 4.3 trillion cubic feet rather, which is a lot of gas. We've never been that high before, just for your information. The highest we've ever been is a little over 4 trillion cubic feet in the beginning of, at the end of the 2016 time period. We're going to be testing storage capacity. We are in uncharted territory here right now as far as it concerns for natural gas storage. No one's projected us ever to be this high. Working capacity depends on who you ask. Theoretically, it's as high as 4.5 to 4.6, but we're going to be pushing that envelope pretty clearly. But when you compare it to where we were last year at the same time in 2019, we're going to be outpacing that level pretty significantly by my estimates of just under 700 billion cubic feet. And then as you transition yourself through the heating season is when we start to see the storage surplus that we are currently enjoying right now disappear under a normal winter scenario. We're assuming that winter's going to actually at least show up to in some degree here and be kind of somewhere similar to the 5-year average. Not extremely cold, maybe not extremely warm as we saw last year, but somewhere lying in the middle of that. And that's when I believe that we'll exit the storage season with just under 1.8 billion cubic feet, or 1.8 trillion cubic feet rather, which is again, pretty healthy number. But this is where things get a little swirly here, is that based on the amount of demand that we have for natural gas from all of the previous components, power gen, industrial, Mexican exports, and specifically LNG exports, I'm projecting a major shortfall. Next October, with the way things are kind of shaping up right now, I'm projecting us to be about 3.2 trillion cubic feet, or almost 3,200 billion cubic feet. That's a massive difference compared to where we are expected to be this year. So again, it's the tale of 2 years here, a very, very bearish 2020 right now versus a much more bullish and price sensitive, in my opinion, 2021.
Thanks, Andy. That really does clarify things for me. And I guess we're right at the 45-minute mark, so I'll tie up today really with the last question. if I were to bring you a client, with who's hedged very little for 2021 and beyond, what would be your advice for that client based on what you've been explaining today and what you see in your forecast? How would you sort of what would you be recommending that type of client?
Well, for anybody that's kind of, that's been fortunate enough to be riding this market right now here, I don't see any reason in the short term over the next few months here to get extremely worried about your positions getting out of whack. In fact, I think that it's very possible that, over the course of the next few months, this market is going to continue to get weaker and weaker in the near term. And by near term, I'm talking as we transition into the July, August, September, and October time period. Where I'm starting to get a little concerned here is about what we're expected to see next year, is that when you start looking at pricing for the remainder of 2020 and pricing for 2021, I think we're going to be in pretty stark difference. My opinion of 2020 for the remainder of the year, that blue dotted line is kind of where the NYMEX futures are right now. But I think the most likely scenario is that we're going to kind of trend below those numbers for at least the next few months before potentially starting to kind of match where they are as we transition out 2020 rather. For 2021, like I said, it's a completely different story. In my opinion, right now, you can see where the blue line is right now, the dotted line that kind of shows the current value of the NYMEX natural gas futures over the 12-month period, as well as the likely and worst case scenarios, all considerably higher. So in my opinion, if you were bringing me a new client, I would say that the risk reward scenario of hedging, not hedging, is definitely skewed to the high side on there's too much risk potentially versus too much gain by floating the market and doing nothing. So my recommendation would be, now's the time to start seriously thinking about getting coverage on the board for 2021, because 2021 is going to be a very, very squirrely year in my opinion.
Yeah, always a bit of a hard sell for clients, simply because the market has been trending down now for so many years, and so many businesses have done better by leaving their positions open to the market. To a certain extent, we're always fearful that a little bit of complacencies come into the market, but no market goes down forever. Correct?
Correct. I am in 100% agreement. Complacent is a great word. People are used to prices continuing to decrease year over year after year over year. And if people are expecting that to happen in 2021 and beyond, I think it's time for them to check, reality a little bit and realize that, the gravy train and the good years that we've had for the last few years, in my opinion, are over. And it's time to start focusing more on risk mitigation efforts.
Andy, that's great. Thanks so much. We're right at 48 minutes, so I'm going to close it with that, because I think that really is something that clients and other businesses will find really interesting. I really want to thank you for spending some time with us today and giving us this sort of global and then macro and micro view of the market. I see we have one or two questions. We will make sure we reach back out to those individuals and answer those questions. And finally, we will also be putting this presentation up on SlideShare, so it's available to participants today. We want to thank everybody for taking the time to spend with us today to learn more about the U.S. natural gas markets in this unusual and unprecedented COVID-19 period of time. Thank you again. Andy, thanks again. We'll hopefully do this again in the next few months to get an update.
Absolutely, Rich. It was my pleasure, and look forward to seeing what the next few months hold.
Great. Thanks, everyone. Take care.
Thank you. Bye-bye.